Macy's is the latest to announce a corporate restructuring program, which means big-time layoffs, about 13% of their corporate staff. And that was even before this week's earnings report, in which the company said it expects lower sales in 2025, making Macy's the latest retailer to warn, like Walmart and Target and so many others, about the state of American consumers. In Macy's case, this downshift has even gotten to their more affluent customers. And those concerns are only going to get a lot worse given the state of the labor market. While everyone wants to put this down on trade and tariffs, the truth is this weakness is all about jobs and incomes. Consumers themselves tell us this. And Friday's payroll report not only reflects Macy's layoffs, it confirms the real basis for this, quote, growth scare, which has even gripped the stock market now. The latest data shows employment plunged in February, and hours keep getting cut. Now, the establishment survey, which is what most people are given, that one was positive yet weak, and it came in below estimates. And people are starting to wise up to the fact that the headline payroll estimate, it isn't reliable. It isn't an accurate representation of the real labor market conditions. To begin with, the payroll number was overshadowed and then some by other parts of the same survey. The average work week is in deep recession territory, as low as it was in March of 2020, indicating however many people may have a job, they aren't working as much as they might want or as much as the economy needs them to. And that point was further confirmed by the household survey, where the underemployment rate soared to a new cycle high. But the biggest shocker, to at least to most of the mainstream, was that the household survey absolutely plunged at its worst monthly decline since December 2023. And the official unemployment rate, which only rose by 1/10 of a point, that was because hundreds of thousands more left the labor force. The participation rate dropped to its lowest level in 2 years. So at best, payrolls were a weak disappointment, but in reality, employment likely took a huge step back last month. The forgot how to grow economy just might be remembering how to recession. That's certainly the worry that Macy's has, along with the rest of the marketplace, even the stock market these days, and the growth scare narrative. Again, everybody wants to put it down to trade and tariffs, but this is all about jobs and incomes. Now, what Macy's reported was that it expects sales to decline again this year, as even affluent customers of the department store chain wait to see how, again, swirling tariffs and inflationary pressures hit the economy. They forecast sales that were down to $21 billion, maybe $21.4 billion, which is down by $1 billion from last year. So they're getting pressured on the top line. It's not tariffs. It's not uncertainty. The payroll numbers that we're going to go over here show that the economy is gaining more certainty. It's just not the right kind. It's uncertain to people who have been listening to Jay Powell go on and on about the strong and resilient economy. It isn't even showing up in the establishment survey. Before we get back to the rest of today's video, I want to tell you about today's video sponsor. I've been doing this for quite some time, and I've been approached by sponsors before, and I've turned all of them down, because I'm not interested in selling just random stuff here on the channel. But today's video sponsor, Monetary Metals, not just some random company. I know Monetary Metals, I know Keith Weiner. I've appeared on their podcast a bunch of times before. In fact, there's a conversation that Keith and I had last year that's sitting in the Eurodollar University member site as we speak. So if you're all interested in precious metals, you need to check out what Monetary Metals is up to. They offer gold owners a way to be in control of their gold while also increasing their savings. You can earn 3% on gold that's paid in gold in their secure gold lease program. So Monetary Metals lets gold owners earn income on their ounces that are paid in more ounces of physical gold. And the interest that you earn that is paid in ounces of physical gold or silver, you get in addition to any price appreciation from those metals during any time that you hold them. So simply holding gold or silver means that you're only preserving wealth, not actually growing it. You can join the thousands of investors that are already earning monthly interest on their physical gold and silver holdings with Monetary Metals. There's a link in the description of this video for all the information you need on what Monetary Metals has to offer. We thank them very much for their sponsorship. Now back to the video. And remember, Macy's forecast here, that's with the idea that the economy is strong and resilient. It's just facing a few headwinds, but otherwise is relatively fine. And Macy's finds out that the economy is not fine, that the labor market actually is experiencing substantial re-weakening. We're getting back to where we left off last summer. What are they going to do after that? Well, that's when you get into the self-reinforcing cycle of the traditional recession. Exactly what the stock market is right now pretty concerned that might be developing all across the U.S. economy, and the rest of the world too, for that matter. But even before we got to the payroll report, Challenger Grain Christmas reported a huge increase in the number of announced layoffs, in the month of February. In fact, they said that job cuts had soared to 172,000, a 245% jump from January, and the highest since July of 2020. Now, a lot of that was federal government layoffs, which were about 62,000. But even with 62,000, you just do a little bit of math here, 62,000 out of 172 leaves 110,000 layoffs for the private sector, which was already well above any other month of this cycle so far. So even though some of those private economy layoff announcements are tied to what DOGE is doing and cutting back on the bureaucracy, there's still a huge amount of private sector layoffs going on over and above what we've become used to over the last year or so. In fact, just retail, again, Macy's sector, retail slashed, at least announced that they were cutting almost 39,000 jobs, which is a six-fold increase from the last year, from February of 2024. And the reason why is because of what Macy's said. Even their affluent customers are struggling. And so given the fact that they don't see anything materially picking up anytime soon, at the very least, they're going to listen to Powell and say things look okay for the future, but we're not going to hang in and just do nothing waiting for that to happen. So Macy's, like a whole lot of other companies, are beginning to think we need to start trimming our costs even more aggressively than we have over the last year. And that's what all the data from the employment sector shows. The Bureau of Labor Statistics, both the establishment survey and especially the household survey, they show the labor market overall is getting back to, if not going beyond, where we were last summer. The last time the stock market was taking this recession stuff seriously. So what the BLS reported for the establishment survey, it gained 151,000 reportedly, at least according to their models, in the month of February. That was below the 170,000 that was expected on average. And it was up a little bit from the downward revised 125,000 in the month of January. In reaction to it was as mixed as the numbers appear to be, at least the headline numbers appear to be. CNBC said, at least they quoted an analyst saying, "We are not putting too much stock in the jobs report at the moment. Today's data was mixed at best." It really wasn't. But we still have no clarity on the economy moving forward with the Trump turmoil. Again, they're blaming Trump and trade and tariffs, but this has been coming for a long period of time. And after the artificial high at the end of last year, we're just coming back to where we were before. Another one, here's Reuters. U.S. job growth picked up in February and the unemployment rate edged up to 4.1%. But growing uncertainty over trade policy, there's again, a deep federal government spending cuts could erode the labor market's resilience in the months ahead. The less than expected improvement in job growth brought little relief to investors who are rattled by the tariff-related market turbulence. No, they're rattled by the fact that the global economy, the U.S. economy too, is going back and picking up where we left off last summer. All the signs point to the same thing. That we got a little bit of a temporary reprieve at the end of last year, but that is quickly, maybe very quickly disappearing. It's been a huge loss of momentum all over the economy. See it in consumer spending, consumer confidence, which is a reflection of the labor market. And now, as you'll see, huge loss of momentum in the rest of the employment statistics, except for the headline establishment survey. Where have we heard this before? That's what I said in the introduction. People are getting wise to the fact that the establishment survey doesn't seem to reflect labor market conditions, certainly that they experience, or financial markets are pointing at and pricing, or other data besides. Even within the establishment survey itself, we saw the average work week at 34.1 hours for the second consecutive month. And 34.1 hours is an incredibly low number. The only time that was matched outside of the Great Not Recession was March of 2020. Every other month going back to 2011 was higher than 34.1. In fact, between 2011 and March 2020, the average work week never got below 34.3 hours. So incredibly weak, which means that however many workers there might be, and the establishment survey says there's more than the household survey, however many jobs may have been gained, they're not the same amount of hours. We see that in the hours index. So the average work week was at 34.4 hours last March, which was already heading in the wrong direction, and then it's just been falling ever since then. That's when we keep coming back to that period last March when we saw a global inflection. We saw an inflection in consumer spending, confidence, and a whole bunch of other stuff. So again, we're getting back to where we were, really never left, the weak economy that showed up in the springtime last year, heading into summer. So we have employers that are likely cutting hours, and that's assuming that, even if they're still hiring the same rate that the CES says, the average work week says that however many jobs there are, those that might exist, They aren't the same level of work and hours as most people expect, most people are really picturing when they think of a strong and resilient economy. And the hours index itself, that's been basically flat to lower since November. So again, the setback after the artificial high at the end of last year. So we've got 3 months in a row now where the hours index has been lower than the peak in November. And it had been on a lower trend, talking about a bigger picture, since March and April of 2022. That was businesses responding to oil prices, not the Fed's rate hikes. As input costs were rising, they responded to the higher input costs by cutting back costs in other places, like we would expect any business to do. So oil prices go up and other prices went up in the supply shock era, the price illusion. Price input costs go up, they cut the costs that they had available. So they cut back on hours, especially from their workers. And you see another inflection in the hours index around Silicon Valley Bank. That's another one that comes up a lot too. The video I did not that long ago, the Fed may have won the battle on the bank crisis, but they lost the banking and economic war because we keep coming back to March and April of 2023 as an inflection, especially in the U.S. labor market. Not just in terms of bank lending and defensive behavior in the banking sector, but the downstream consequences of that, which are right here in terms of labor market weakness that continues to get weaker. Forgetting how to grow is forgetting even more and getting to the point where maybe we're seeing remember how to recession. That's the implication over on the household survey side, or the CPS data. The household survey absolutely plunged in the month of February. Again, sort of like the layoff announcements from Challenger Gray and a whole bunch of other data suggesting the tremendous loss of momentum in the economy. Falling by 588,000 in the month of February, that's the worst monthly decline since December of 2023. Now, we have to remember, keep in mind here, that the household survey got its population control factor adjustments last month, which means, in truth, the levels, the amount of estimated employment are not comparable from year to year. But if you remove the population control factors, which you're not supposed to do, but if you do that, you can get a much better sense of how the trend in employment has gone, at least according to the household survey. And what you see is exactly what we've been seeing all along. Employment has just hit a wall. It hasn't crashed. It isn't going down like we saw in 2020, but going sideways, going nowhere for a prolonged period of time is an enormous contraction. It's an even more unappreciated contraction because everybody's conditioned to believe if it's not a huge negative number month after month after month, it must be strong and resilient. But what we're seeing with the setback in February, minus 588,000, huge decline there, is that we haven't left the same pattern as before. Nothing has shifted in that regard, which means we're still in the same weak labor market, which further means that what companies like Macy's are responding to are not tariffs and uncertainty. It's more and more certainty in the economy that it continues to be incredibly weak and that nothing actually meaningfully changed last year in October, November, and December and into this year. If there was a small rebound, and the household survey does show the same thing, it was temporary. So the household survey had big drops in October and November. Then you see the rebound in December and January after removing the population control. There was still a couple 100,000 employment gained. But then right back in February, got this big give back, this big drop, another indication of a big loss of momentum in the economy. So we got that short-term burst of optimism, but now more and more what the stock market's worried about, the bond market, lower interest rates, more and more we're seeing the give back or the payback in the economy. In this case, in the labor market itself. And it's not just the household survey and measure of employment. It's all the rest of the data too. Full-time jobs absolutely plunged, down by 1.2 million in the month of February, which echoes what we saw in the CES numbers for the work week, the really weak work week, and the number of hours. Now, the 1.2 million plunge in full-time positions was only offset by 610,000 in part-time, which means it's even worse. So you have a net loss of about 588,000, which the household survey overall showed. But of the other 600,000, those were full-time jobs that were likely converted to part-time jobs. So there's your loss of hours on top of a major loss of employment. Even though, despite all that, the unemployment rate only ticked up to 4.1% from 4%, simply because another huge amount, 385,000 former workers, exited the labor force. The participation rate fell to 62.4%, which was the lowest since January 2023. So the lowest in 2 years. That's not a strong labor market. That's not a resilient labor market. When people exit by the hundreds of thousands and the participation rate drops this much, that means that the labor market is incredibly weak, and it is getting weaker. When you hold the participation rate steady, which you should do, you should count all these labor market dropouts, or the vast majority of them. What you see is that in addition to the 203,000 that were added to the unemployment, official count of unemployment, there should be overall almost 1 million more to account for all these labor force dropouts. And when you put those two together, when you add 989,000 to the numerator and the denominator, the unemployment rate, the adjusted unemployment rate should be about 4.69%, which here matches, or very nearly matches, the November peak before the artificial high in employment kicked in December and January. So tremendous loss of momentum, tremendous increase in unaccounted for unemployment, and even accounted for underemployment. The underemployment rate, the U.S. rate, that one soared all the way to 8%, which was the highest since October of 2021. So it got massive increase in underemployment, even in the BLS's official count. At the same time, there's a big spike in unemployment, both officially as well as unofficially, in the form of labor force dropouts. The participation rate falling all the way back to 62.4%. That is not a good sign for strength in the labor market. And the fact that it's tracing out the same pattern that we see in all these other data, a temporary high last year and then the loss of momentum this year, that's not growth scare. That's more and more confirmed reality, which is why it's being taken so seriously in even places like the stock market. Like I said, the stock market, what it's afraid of, what everybody in the stock market is afraid of, is the traditional recession. And so whenever you see signs of a traditional recession, and actually when you see signs that are leading to signs of a traditional recession, you get out of the stock market because everybody believes that everybody else believes that everyone believes. You sell stocks in recession. And that's kind of what we're seeing here, similar to what had happened last August, only in this case, we don't have the carry trade in Japan to give us a sort of an excuse about why this is happening. This is happening because everyone can see outside the mainstream that wants to blame trade and tariffs and uncertainty. Everyone can see, like Macy's, this is real weakness about labor, jobs, and income, consistent with the forgot how to grow economy, forgetting even more, and maybe going beyond that even further. So it is easy and convenient, like Macy's and everyone else, to blame everything on trade wars and uncertainty. But it's neither. In fact, as I said, the economy is gaining certainty. When you look at the actual data, especially from the household survey, but even the establishment survey in ours, what it shows is that the economy, the labor market, has been incredibly weak for a long time before we even got here. And that now that we're here, we had the same pattern that's playing out everywhere else in the data, the artificial bump at the end of last year that is giving way to a period of payback that is likely to be pretty substantial and serious. The fact that Macy's, among others, want to blame uncertainty doesn't stand up to scrutiny. You can call it uncertainty, you can call it a growth scare, you can blame trade wars, but the reality is that the economy that we saw emerging last summer before the transitory deviation last fall and into the winter, the economy is still there. The fundamentals never change. That means jobs and incomes. And what everyone is confronting is the possibility, very real and growing possibility, the forgot how to grow economy is indeed remembering how to recession. That's exactly the reason why Germany just went crazy announcing its own kind of bazooka, sending bond yields there soaring. I went over all the details and what it actually means in the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and Eurodollar University subscribers. And until next time, take care.